Hello traders, Gary Wagner for Trending Markets, about 11:15 in Honolulu, 5:15 in New York. It's Wednesday, 14th day of October, and we do have the equities markets, which began to sell off yesterday. Of course, we pulled profits on our long S&P trade, continuing to slide lower. This time, though, sliding almost a full percentage point in the Dow Jones Industrial Average, 16,924. So it has broken below 17,000. When we look at a daily chart of the Dow Jones Industrial Average, we have a variation off a three-river evening star. Now, the reason that I'm calling it a variation, you can see that I have added a slide up here of a model of a three-river evening star. You get this red star gapping above, and typically the green candle would be a much more robust or longer candle. And the pattern itself, the three-river evening, is comprised of these three candles right in here. So it is certainly not a pure three-river evening, but it is a three-river evening variation that we are getting here. Now, when we take this and then take a look at, of course, the S&P 500, that closed off about 0.5% on the day. Now, realize on yesterday's trading activity, you had the Dow Jones Industrial closing off about 0.5%, but you had the S&P 500 closing down about a full percent, so you're kind of getting an equalization. But here is what gets really kind of worrisome and why I think our next play will probably be to the short side on the Standard & Poor's 500. I draw your attention to the chart that I've just pulled up. It's a daily chart, E-mini S&P, and we've got two primary moving averages, our longer 200-day and then our 50-day moving average. A break below this 50-day moving average to me would signal dramatically lower pricing ahead. Now, in terms of where we could see this market go to, I've put up a basic fib retracement. This fib retracement simply looks at the bottom of this market at 1831 after our dramatic sell-off and our true correction in the market up to really the double peak that we saw in this rally. You can see that we've hit this 2013 here as well as 2013 here. So we absolutely have really strong resistance in that area. Now, when we look at that, next real level of support does come in below this 50% moving, 50-day moving average, and that comes in at around, call it 1970, 1943 is a 38%, and then 61 doesn't come in until 1900. So if we see a true correction develop within this marketplace itself, I think the different areas we'll look at would be 1970 and 1943, but I wouldn't initiate a short position at all unless we broke solidly below the 50-day moving average. So the other market that I do want to look at, because I think that there's going to be an opportunity presenting itself in crude oil, crude's been very, very good to us throughout the year, is the fact that we had this market sell off dramatically. Now, I was looking for the market to go to $52 per barrel. I was absolutely incorrect. It only went to about 51. We did get stopped out of that trade the other day. We have had a solid move down. And when we consider where this market is currently having a low, which is right at around 46, we want to see if any kind of support comes in the market, because my sense is if it breaks through this particular price point at 46, it's probably headed lower, maybe as low as 44. That was the bottom level in which we found some support prior to that, between 44 and 41, but traders realize a break below this particular price point, and it's probably going to look to even possibly test these lows at 38. So I think that we've actually got some room to the downside. I'm not a long player here because we had an utter failure in the market. Once we got this breakout, we didn't even make it to our first real level before running into substantial resistance and moving lower. This has been Gary Wagner, wishing you as always good trading. We'll talk to you tomorrow for another daily update review. Bye-bye.